because we are assuming that all factors.
Greetings, candidates, and welcome to the manifested e-learning platform. The subject is advanced financial management. We continue with the topic mergers and acquisitions. In our today's session, we're going to discuss the arguments for and against the use of mergers and acquisitions as tools for corporate expansion. Why would companies choose to merge? Why would a company choose to acquire another one as a tool for corporate expansion? Because by now we are aware that mergers and acquisitions are tools that companies use for corporate expansion, but these tools come with both potential benefits and significant risks, benefits and disadvantages, advantages and disadvantages. These advantages are what we are calling arguments for mergers and acquisitions. So what are the arguments for the benefits? We begin with the benefits, then we'll move on to the disadvantages. Why would companies choose to merge or companies choose to acquire other companies? One reason is to increase market share. Increase market share. One obvious benefit that may accrue to a company, increasing the market share. Acquiring or merging with a competitor can rapidly expand a company's customer base and market presence. That is one benefit. Second benefit for mergers and acquisition is the economy of scale. Economies of scale. Combining operations through merging can lead to cost savings through shared resources, bulk purchasing, and streamlined processes. That can lead to economies of scale. Access to new markets. New markets. Mergers and acquisition can provide a company access to new markets and technology. Mergers and acquisitions, in other words, can provide a quick entry into new geographical regions or access to innovative technologies that would take years to develop organically or internally. Instead of a company waiting to grow organically, to grow internally, the company can choose to merge with another one so that the benefits can be enjoyed quickly. Access to new markets. Technology. Number 4 benefit is diversification. Diversification. How is diversification a benefit? Now, acquiring companies in different industries can reduce risk by diversifying revenue streams. Diversification. 5 is enhanced competitive advantage. It can lead to enhanced competitive advantage. Mergers and acquisitions can lead to enhance competitive advantage by combining strengths. When companies come together, companies combine strength, that can create a stronger and more competitive advantage. 6 faster growth. Faster growth. Mergers and acquisitions can lead to faster growth. Mergers and acquisitions, in other words, can allow for rapid expansion compared to organic growth. Now, the list is not complete without mentioning synergy. Synergies. The combined company, after merging, often achieve more together than the individual companies could separately achieve. We always say two are better than one. What two companies can achieve together far much outweigh what each individual companies can achieve separately. That's what we're referring to as synergies. So these are 7 benefits. Let's discuss the disadvantages of mergers and acquisitions. Disadvantages or arguments against use of mergers and acquisitions. What are the disadvantages? One is disadvantages or challenges. We have integration challenges. When companies merge, there is always that difficulty or challenges when it comes to integration, merging different company cultures, merging the different systems of a company, merging the processes. That can be a complex exercise, and that is one challenge that comes with mergers and acquisitions. How to merge the different corporate cultures, company cultures, the processes, the systems, and so on. 2, cultural clashes. Cultural clashes. Differences in corporate cultures can lead to conflicts. It can lead to employee dissatisfaction and also decreased productivity. Cultural clashes. 3, financial risks. There are also financial risks that are associated with mergers and acquisition transactions, which may involve significant debt. For a company to purchase another company, the acquirer or the predator may be required to seek for debt, which can lead to financial risks. So mergers and acquisition transactions often involve significant debt, and there is a risk of overpaying the target company, which may lead to financial risks. We also have challenges associated with complying with regulations. M&A deals are subject to regulatory scrutiny, particularly the competition laws, which can delay or even block transactions. Another challenge is associated with employee morale, employee morale and turnover. This is yet another challenge associated with mergers and acquisitions. Employee morale and turnover. Mergers and acquisitions can create uncertainty among employees, and that can lead to anxiety, that can lead to decreased morale, and ultimately high turnover is a challenge which the management should take note of during mergers and acquisitions. When employees are told that the company is going to be acquired, that can lead to anxiety, uncertainty, and that affects productivity, and it may increase turnover. That is disadvantage number 5. Number 6 is valuation difficulties, valuation challenges. During mergers and acquisitions, it may be necessary for the company that's merging or the company that is being acquired to be valued. So accurately valuing a target company can be challenging, and we've seen in the past companies overpaying. That is a common risk, overpayment, because payment is based on valuation. If no proper valuation is done, then company may end up being overpaid and so on, and that can be a great challenge. 7, failure to achieve synergies. Failure to achieve synergies. One of the main reasons for merging and acquiring companies is to achieve synergies. But sometimes the anticipated benefits of mergers and acquisitions may not materialize, which may lead to financial losses. That is number 7. The 8th and last disadvantage here is disruption of core business. Disruption of core business. Disruption of core business. Mergers and acquisitions can sometimes affect the operations of an entity. They can divert the management's attention. Mergers and acquisitions can also divert resources from the company's core business, and that is a challenge. So these are 8 disadvantages or arguments for and against use of mergers as tools for corporate expansion. There are other tools that companies can use when planning expansion, like what we call developing the internal processes can also be another way to expand. You understand? What we call organic growth. A company can grow organically, or company can choose to merge or acquire another one in order to achieve corporate expansion. In our next session, we will be discussing the mergers and acquisitions versus organic growth. For now, we take a break from today's lesson, where we've discussed the arguments for and against the use of mergers and acquisitions. Thank you for attending the lesson. Bye-bye.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have 2 types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries, and then we also have another type of a group structure which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore, maybe in this case we can say that there are different types of group structure, structure, including number one, we have the horizontal structure. Number two, we have the vertical structure, and also number three, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company, remember also the parent company here is called the investor because it has invested in other entities. The parent company or the investor has a direct shareholding, in two or more subsidiaries, two or more subsidiaries. So the parent company here is having direct shareholding in two or more subsidiaries. So a good example of a horizontal structure, let's assume that we have A Limited, and which is the parent company, So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries, B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say in this case, the group accounts, are prepared in the normal way, i.e. by adding similar items of assets, liabilities, revenue, and expenses, revenue and expenses of the parent company and its subsidiaries. So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group. The group. So let's move and look on the other type of group structure, which is number two, and that is vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary company, and also indirect shareholding shareholding in a subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a sub-subsidiary. So what do you mean by that? Let's assume that we have three companies, and A Limited here, we are told, for example, acquired 80% of the ordinary shares issued by B Limited, and then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure, because the parent company here, which will be which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the sub-subsidiary. Subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know, and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the sub-subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the sub-subsidiary. Indirect shareholding in the sub-subsidiary. Subsidiary. So how do we compute that particular parent company indirect shareholding in this particular sub-subsidiary? So what we do, we take the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is the subsidiary, and then B, which is a subsidiary or basically do have a shareholding of 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the sub-subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the sub-subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect what? Shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a sub-subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue, and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the sub-subsidiary. Number two is you need to identify the date, identify the date when the sub-subsidiary became a member of the group. So number two, we can say identify the date when the sub-subsidiary became a member of the group, became a member of the group, became a member of the group. And basically that particular date is very, very important, because when, for example, preparing number one, when computing the goodwill of the sub-subsidiary, you compute it on this particular date when the sub-subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the sub-subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the sub-subsidiary became a member of the group. And actually the sub-subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the sub-subsidiary. So therefore you can say that the sub-subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the sub-subsidiary, acquired the sub-subsidiary. So basically we are saying that the sub-subsidiary will become a member of the group on the later of these two dates. On the later of these two dates. The later of the date, the parent company acquired the subsidiary. So like maybe let's assume that we are told A Limited acquired shareholding in B, maybe on 1st of January, like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. 1st January 2022. Therefore, in this case, we are saying the subsidiary will be deemed to have become a member of the group on the later of the two date. The later of the two date. The date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the sub-subsidiary became a member of the group, of which you have said it must be the later of the two dates. So the other important point number 3, point number 3 is regarding the cost of investment, cost of investment in the subsidiary, cost of investment in the subsidiary. So when talk about the cost of investment in the subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the subsidiary. In acquiring the shares of what? The sub-subsidiary. Now, this particular cost of investment in the sub-subsidiary usually is split into two parts. So first of all, we compute the amount due to the parent company, or we compute, yes, amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the sub-subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the sub-subsidiary. We compute this by taking a cost of investment in subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited in acquiring the shares of C may be paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the sub-subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 8 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the sub-subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company in computing the goodwill of the subsidiary of the subsidiary. So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, investment in subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the subsidiary. NCI shareholding in the subsidiary is 20%. 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year, so that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is the parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
Greetings to you all and welcome to the lesson. The subject is business and data analytics. We've been studying the first topic, introduction to data analytics. So far we've done the CRISP, which is an acronym for the Cross-Industry Standard Processing for Data Mining Framework. Under that subtopic, we discussed the data concepts, the conceptual concept, logical concept, physical, and also physical data models. We went through the stages in data life cycle. Then in the second subtopic, we've begun looking at big data and data analytics. We, in our last lesson, defined big data. In our today's session, we're going to describe the 5 V's of big data. The 5 V's of big data. And to remind you, candidates, big data, as the name suggests, is data that is very large. Big data is defined as very large data sets having large, varied, and complex structure with difficulties of storing, analyzing, and visualizing for further processes or results. So big data is a combination of the unstructured data, the semi-structured data, and the structured data. All right? Big data is a combination of data that is unstructured, semi-structured, and structured. Unstructured, semi-structured, and structured. Do you understand? And big data can be mined to gain insights, leading to predictive modeling and other advanced analytics applications. Big data can also be used to improve operations. Big data can be used to provide customer service. Big data can be used to create personalized marketing campaigns. And all that increases value. Okay? And as an example, big data can provide companies with valuable insights into their customers that can then be used to refine marketing techniques to increase customer engagement and conversion rates. And organizations that use big data have a potential competitive advantage over those that don't have, since they make faster and more informed business decisions as provided by the data. So in our today's lesson, we are going to describe the 5 V's of big data. So by the end of the lesson, you should be able to describe the 5 V's of big data. And these V's also help us to understand characteristics of big data. The V's are: 1, volume; 2, variety; 3, velocity; 4, veracity; 5, value. 5 V's. 1 V, 2, 3, 4, 5. 5 V's. The first one is volume. Volume refers to the quantity of data. Volume refers to the quantity of data. It refers to the amount of data that exists. And volume is like the base of big data, as it is the initial size and amount of data that a company can collect. And if the volume is large enough, it can be considered big data. But we know what is considered to be big data is relative. What is big data to company A may be small data to company B. And may also change depending on the available computing power that is on the market. So volume refers to the quantity of data. Number 2, variety. Variety. Variety, on the other hand, refers to data types. Types refers to data types, because we have diverse types of data. We have diversity of data types. An organization may obtain data from a number of different data sources, which may vary in value. Data can be obtained from outside an enterprise, or data can be obtained from within the enterprise. We saw earlier we have unstructured data, which we know is data that is unorganized and comes in different files or formats, such as texts, audio data, we have video format, log files, and so on. We have data that is semi-structured. This is data that may not have been properly organized into specialized repository, but it may have associated information. And it makes it easier to process it as compared to the unstructured data. But structured data, meanwhile, is data that has been organized into formatted repository, meaning that such data is made more addressable for effective data processing and analysis. So there are various data types depending on data that is received from different sources. Data may be in form of text, it may be verbal, it may be written, it may be in video format, data may be in audio format, data may be obtained from without the organization, data can be obtained from within the organization. So this is a characteristic of big data. And I've said data that is structured is easier to process and analyze such data as compared to data that is unstructured. Then thirdly, we have velocity as the third V of big data. Velocity. Now, velocity refers to the time that is taken to process and analyze data. It refers to how quickly data is generated and how quickly data moves from point A to point B. And velocity is an important aspect for companies that need data to move quickly. There may be need to have quick data flow so that such data is available at the right time to make the best business decisions possible. And an organization that uses big data will have large and continuous flow of data that is being created and sent to different destinations. All right? Big data being generated quickly. big data being processed quickly or sent to different destinations for processing. And we say that data could flow from sources such as machines, such as networks, such as smartphones. Data can flow from sources such as social media. And such data needs to be digested and analyzed quickly. And at times, such data ought to be analyzed real time. And I can also say that it may be better to have limited set of collected data than to collect more data that an organization can handle. Why? Because that can lead to slower data velocities. For what is the point of having big data that is not analyzed or that is not processed? So it's rather you have a limited amount of data that can be processed, that can be digested, that can be quickly analyzed, if possible real time, because at times information may be required, decisions may be required to be made real time. Therefore, data has to be made available for making such decisions. Velocity refers to how quickly data is generated and how quickly data is moved or flows from point A to point B. The fourth V is veracity. Veracity. Veracity refers to the accuracy of data. The accuracy of data. The correctness of data. The quality of data that is gathered. So gathered data could have sometimes missing pieces. Data gathered could also be inaccurate. And it may also not be able to provide real valuable insight. So veracity refers to the level of trust that a leader has in the collected data. Because sometimes data can be messy. Data can be messy, data can be difficult to use. And large amount of data can cause more confusion than insights. Especially if such data is not complete. So veracity refers to accuracy, refers to the quality, refers to the trust that the leader has in the information that is gathered. The correctness of data. So data that has missing, that is not accurate, that is data that cannot be relied upon in making decisions. So veracity is a very important feature of big data. Then we have value. Value. Value refers to the value that big data can provide, the added value that big data can provide, and it relates directly to what organizations can do with the collected data. Because big data is only relevant or important if it adds value. Being able to pull value from big data is a requirement, as the value of big data increases significantly depending on the insights that can be gained from them. So it's not enough to have big data. is not to have to just gather data and have data. The question is such data valuable to the organization? And organizations can use the same big data tools to gather and analyze the data, but how they derive value from that data should be unique to them. All right? So here data refers to the quality of data. The value, this we said refers to the quality of data. This is value added. Veracity refers to the quality of data. The quality of data. The accuracy of data. So, candidates, these are the 5 V's of big data. 5 V's of big data. The first V, volume. Volume. The second V, variety. The third V, velocity. The fourth V, veracity. Then lastly, value. We've said volume refers to the quantity, the amount of data. Variety refers to the data types, which could be unstructured, semi-structured, or structured. We say that data comes in different types, could be in different formats: audio format, text format, video format, log files, and so on. Velocity refers to the time that the organization takes to generate big data and to process or analyze big data. Veracity, on the other hand, refers to the accuracy or quality of big data. Veracity. Then lastly, value, which we've said refers to the value that big data can provide. We've said that it relates directly to what organizations can do with the data that is collected. We said collecting data is not enough. What is important is what value do you derive from the data that has been collected? And that brings the lesson to an end. The objective of this lesson was that by the end of this lesson, you, the learner, should be able to describe the 5 V's of big data, and that will form the basis of our today's assignment. Describe the 5 V's of big data. Thank you for attending this lesson. I hope to meet you in our next lesson. We'll continue to share knowledge in business and data analytics. Thank you. God bless you. Bye. I welcome you once again to the Manifested eLearning platform. The subject is Principles of Marketing and Communication. Today, we are proceeding with the first chapter, and we are going to learn the importance of marketing. That is our focus for today. We will be discussing the importance of marketing, and therefore, by the end of this lesson, we should be able to explain the importance of marketing. If you recall, in our last session, we defined 3 key terms of marketing. One being market, number 2, marketing, and market research. We defined a market as a group of all the actual and potential buyers of a particular product or service. We went ahead to define marketing as the process through which organizations identify customer needs, engage customers, and also build strong relationships by creating value for customers in order to earn value in exchange. So that's the meaning of marketing. Today we want to discuss the importance of marketing. And marketing, we know, is vital to both business organizations and also the economy, and it performs various roles. And the first role or importance of marketing is identifying customer needs. One, identifying customer needs. That's one reason why marketing is important. Identifying customer needs. Marketing helps organizations understand what customers want through market research and feedback. For example, by providing or studying customer preferences or income levels, or by studying tastes and buying behavior, organizations are able to design products and services that meet real market needs rather than guessing. So instead of guessing, a company can, through marketing, identify customer needs. For example, an institution like Manifested Publishers, which offers KASNEB online tuition, may survey students to know their preferred study times and course formats. And the course format could be online format or physical format. And that ensures that services meet students' needs. So instead of just guessing what students may want, marketing may help the organization to first identify the needs of the customer, then develop products that meet the needs that they have been identified. So that's one reason why marketing is important. Identifying customer needs. Number two is creating awareness. Marketing creates awareness. Marketing informs customers about the existence, the features, and even the benefits of products and services. And that can be done through advertising, through promotions, through social media, and marketing with the products of the company. Creating awareness. You recall we did mention that marketing is very broad in scope, and it includes not only identifying customer needs, but it extends to promotion, to distribution, and so on, including customer relationship management. So through marketing, the organizations or companies can create awareness of their products. They can create awareness of the features of the products, the benefits of the products, and so on. You understand? For example, advertising the KASNEB online tuition or classes on social media platforms helps students become aware of the available courses and the enrollment periods. I know some of you came to know about Manifested through marketing. Manifested may have done marketing on social media, which caused you to know the existence of the products at Manifested Publishers. So that's one reason why marketing is important. Creating awareness. Creating awareness. Number two or three, marketing promotes profitability and sales. Promotes profitability and sales. If you are running a company and you want to increase your profits, that can be done through marketing. Effective activity stimulates demand. Effective marketing activities can stimulate demand. You understand? Yes. Marketing activities can stimulate demand, leading to increased sales, leading to increased profits. Effective promotion, pricing, effective distribution strategies encourage customers to purchase products, which then improves the revenue and business growth. The company may offer discounts on say television, on if it's a company that is selling televisions, the company may offer discounts on the televisions or any kind of product which then promotes profitability and sales. Number 4, marketing facilitates exchange. Facilitates exchange. This is exchange of value. Marketing links producers and customers, which then enables the exchange of goods or services for money. The value that the customers get from the product would be from the companies is products or services. The companies sell value in form of products or services, and the companies receive money or loyalty in exchange of the products that are sold to the market. So through marketing, there is that exchange of value between producers and the consumers. You understand? Through proper distribution channels, through pricing and communication, marketing ensures products reach the right consumers at the right time. The products reach the consumers at the right time. That is one reason why marketing is important, because there are times when you may have products and the products may not be needed at certain times. The products may come late or even later when the need has already been met, or when the times are not for the products to be consumed. For example, online platforms allow students to register, to pay, and also access study materials, which makes the exchange process very smooth and efficient. So marketing facilitates exchange of value. Number 5, encourages innovation. Marketing encourages innovation. And how does marketing encourage innovation? Now, marketing feedback drives product improvement. It drives product development of new products. You understand? When you get feedback from the market, because marketing involves also studying the needs of the customers. When the company studies the needs of the customers, the company gets ideas on how to improve their products, and that encourages innovation. Product development is made possible through marketing because of the feedback that the company gets from the customers. The company may also receive complaints from the customers. Customer complaints, suggestions, and also the changing tastes may guide the business in improving existing products or introducing new ones. For example, students requesting recorded lessons may lead to the introduction of pre-recorded video lectures. You understand? A company may introduce